Hey, good morning. Brendan Rendo with the Homes in Orlando team at Next Home Neighborhood Realty. And of course, joined by my good friend, Joseph Dion of Apley Home Loans. We just want to say good morning. And this is, one of these days I'm going to get used to that delay.
Maybe, maybe, maybe.
Good morning, man. How you doing this morning?
Good. I'm recovering. I had a near fatal heart attack on Friday.
Oh my
Obviously,
gosh. Yeah,
those
yeah.
rates were.
When did they let you out of the hospital? Sunday, Monday? I mean, you
Well,
guys took a beating.
they told me to suck it up and just kicked me out on my. No, but you're talking and I know we talked last Thursday and we had a lot of conversation. We were talking about rates and you know, when last week was a bad week, and that was going into Thursday. It was a bad week because of Monday and Tuesday, and I was like, okay, Wednesday not much worse. Thursday was very calm, and then
You
Friday
got hammered.
we just got hammered. It was a bad week because of Monday and Tuesday, and then Friday was we saw more loss on Friday than we saw Monday, Tuesday combined.
Yep. Yep.
Like
It was that, from what I was reading, it was one of the largest single day jumps in mortgage rates
yeah.
in like the past 20 or 30 years.
Yeah, it was nuts. It was like my phone was and every time one of my investors updates rates or anything, we get those little notifications. My phone was just chirping all day because it was so unstable. It was just getting worse, gets worse, gets worse. And at one point we were down 0.98 and then it rebounded to the end of the day around 0.77. But now it's still it was just nuts. It was a crazy Friday and not how I wanted to enter the weekend. Not at all.
How does it come? I mean, I know how I kind of used to handle them, but never. I don't think I ever had a jump like that while I was a lender. How do you handle that with your clients? What do you say? Because I know it's competitive out there for you.
It's super tough, and that's the hardest part is what borrowers don't realize sometimes, and what the biggest challenge is when you see a big jump like that and you see a day of that nature, it's kind of two-prong approach. The instinct is to say, hey, usually when we see something like this, we rebound. There's a little bit of a rebound in the following week. But the problem is that the way the market has gone the last month and the month of March is we haven't really seen a rebounds. Almost every day, if we have a positive day, it's been followed up with negative days. So it's kind of and if we have negative days, they're more than likely followed up with negative days in the month of March. And we saw rates go up way high. So it's kind of in that moment, it's all I can do and all I can explain is say, here's where the rates are. Here's what's happening in the economy. Here's everything that's impacting it. And the hard part is if you like it, lock it. Maybe they get better. But we don't. I can't promise you they will. And the bad part is they could get worse.
Where did you see the rate peak for you on Friday?
So we saw that 30-year conventional 20% down, 740 credit score hit. It touched for us right at 5, but those lower scenarios, maybe a 720, 5% down, still a strong buyer. Those were touching 5.25 on Friday.
Oh.
And then we saw the crazy part is then we have this week. And this week has been much different.
Been a little different, hasn't it?
Been a little bit different. And everything we lost last Friday, we've made back in gains this week.
I know we were talking this morning, we were checking out that 10-year T. Yeah. And it's actually back down to 2.33. So it's had a nice recovery this week.
Yeah. And the crazy part is we've had some conversations of this is how does the war in Ukraine and Russia, how does that impact us? And a lot of this recovery this week was triggered because there was a lot of positive reaction by that, maybe this war is going to subside. They're going to come to an agreement. And then that kind of triggered this little bit of a recovery on the rates for us, which, we keep talking about the influence and there's a lot of places out there saying, oh, it doesn't have much, but there clearly is a correlation.
Oh, definitely. And there's some interesting things in the background that I don't think a lot of people knew or saw. One is the Bank of Japan, their central bank, shut down bond trading on Friday.
Yeah,
Shut it down.
That's crazy right there.
So where does that money all of a sudden flow?
Mm-hmm.
To the U.S.
Yep.
So now you've got more buyers, so they're willing to take it for a little bit less. So that could have helped with the rally. And then probably one of the most interesting things I saw last week is, BlackRock. Everybody.
Yeah.
The big bad corporation who owns all the real estate in the world. They defaulted on their property in New York City last week. They let go of a $301 million note and turned it back over to the bank, Deutsche Bank, on Friday.
Really?
I mean, that you sit there and think about that. It's like, okay, they're willing to let go of a piece of property in downtown Manhattan and default on a $300 million loan.
I thought iBuying was where it's at right now.
So it's like, okay, that one, I haven't deciphered that one yet.
Yeah.
Because I'm trying to think, like, what are they seeing? Because here's the biggest real estate investor in the world. What are they seeing that they're willing to let go and take a hit? Because you got to realize that takes a hit on your credit for them too. It's a default. Yeah. So kind of wondering, what are they seeing that we're not seeing, that they're willing to walk away from a major property in New York City, hand over the.
Yeah, and it's so, like, I know that we're starting to see some articles, and you shared a couple with me. We're seeing some articles trickle of that fear of, is there a bubble? Is there not? What is it going to look like? Are we in a recession? Or are we not? Are we heading that way? What does it look like? And it's kind of, that's kind of the part where it's really interesting to see us kind of play out right now.
Sure is.
To take a look now. I mean, you take, we look at recessions and housing and everything, and it's just like, I'm not saying we are, but a lot of data saying we're trending that way. We're probably pretty close if you look at the 10 and 2, that leading indicator. Like, that's at point. That's at 0.04, and actually it touched 0 for a moment yesterday, right?
Yep. On the 30th, it touched 0. So that is one of the leading indicators to a recession.
Yeah.
And essentially, I was reading another article about interest rate jumps. And it said it doesn't necessarily mean decrease in prices, but it does mean decrease in appreciation, acceleration. And that's one thing I think we really are seeing. Is we're not seeing the jump. We still got strong demand in Orlando, extremely strong demand. I think 3 people I've talked to were all from out of state, a New Yorker, one from Texas, and I think the other one was from Chicago this week, all looking to move here. And it's like, oh man, no more, please, no more. We're crowded. So the demand is still there with people relocating. We're headed into the spring season, which we're going to talk about a little bit next week. So we're hoping to see the inventory start to increase. It is slowly moving up because our days on market has increased. We're actually to a 30-day or 31-day average before sale days on market for homes in Orlando, which 6 months ago we were sitting at 17 or 18 days. So you've seen, roughly, what is that, 100% increase in days on market. So you see those trends and you see the price decreases. So depending on what area of Orlando you're in, you may start to see some settlement and a little bit easier ability to find a home. I think a lot of them are still going to need work. People are still going to try and get maximum price on it. And, they just feel, hey, it's, it's still a seller's market, maybe not as strong of a seller's market, but still a seller's market where they can make their demands, and 99% of the time they're going to get them.
So I feel like, as listening to you there, I kind of got a semblance of what we might see is we might see a little bit of the seller, that little kind of sellers being, I don't know what's the right word, maybe like uncomfortable with accepting offers. Like,
Mm-hmm.
kind of like, hey, like, we're listed at 400,000 and we get that $400,000 offer, but they're like, yeah, I've been hearing everybody's been getting 10%
Yeah.
more.
Yeah.
And
Yeah.
so they don't
Everyone's getting
accept
multiple
it,
offers. Yes. It's like,
so then it kind of sits a little bit longer and it creates almost like, and that's where it's like, does that create a little bit of that seller fatigue? We've been in like kind of a buyer fatigue environment where a lot of buyers are leaving the market because they're just frustrated with it. Maybe we see a little bit of a
isn't it
flip.
interesting? Seller fatigue would be like 2 weeks.
Yeah. Yeah.
I mean, honestly, it's interesting because, like I've said before, sometimes I tell my clients, we're not going to go see the house that got listed on Friday.
Yeah.
Let it go through the weekend.
Yeah.
If it's still there, let's go see it. Because it's amazing that how like you said, the uncomfortableness, the anxiety. It's like, my house didn't sell over the weekend. What's wrong?
85
What's
offers.
wrong? Yes. Oh my gosh. So that's interesting. But I wanted to go back to something about last Friday. For instance, I had a transaction. I was a listing agent, and the lender on the buyer side made some really bad decisions as far as the processing, and we ended up having to extend. When you've got a market as volatile as this, what happens to your clients when they don't close on the closing date and their lock expires on that date? What happens?
So the biggest thing and the most important thing for buyers to make sure is that they know that they know when their lock is set to expire. Like 100% know when your lock is set to expire. And it's, when you go into pricing and everything, like a lot of lenders and everybody, we get our best pricing on the shorter term, because when we lock it, we're saying, hey, like, this is where we're basically hedging the market and saying, hey, if we do a 15-day, we're hoping that the market is at this when we close on those 15 days, or we do a 30-day. So it gets more expensive the longer initial lock you do. But what I've actually talked and seen to a lot of different lenders and people in the industry, as well as some investors and stuff, is it's not as point blank, and it's not as straightforward as it once was, where it's like, hey, if the market's flat, and your rate lock expires, you renew it, or you or you extend it before it expires and it costs a little bit of money, or you relock it because the market didn't get worse and it didn't cost you anything, right? But we're not in that. We're in an extremely volatile marketplace. So when you work with certain investors, like our conventional VA, USD, our straightforward, our kind of our federally backed kind of student Fannie Mae, Freddie Mac, FHA, HUD, all those entities, like those ones, as long as you don't let that lock expire, you can extend. And the cost to extend, it's going to be a little bit higher right now than what it once was. Like the cost could be, it might be a little bit higher cost when you talk to, your bank or somebody else, but it's still there. Where we're seeing the big change, though, is on those products that aren't federally insured and backed, meaning I'm seeing, and I've talked to a lot of people in other areas or realtors, having their clients call me to touch base on it because their lock expired and they weren't given an option to extend the lock. They were told that they had to relock at market rate, at worst case pricing. And these are those kind of your non-QM or your not, your jumbo loans. Like that's a big one in Central Florida. That's a big one right now. Like there's a lot of jumbo, but those are kind of privately held. Like the institutions that typically, like if you're going to someone to underwrite, that institution is who's ensuring that like there's nobody behind them protecting them. So they're not giving that grace sometimes. Your bank statement loans. I've seen investors that they've canceled all their locks and they made everybody relock at worst case. And these aren't investors I work with, but this is like news, that are going through and saying these things and doing these things. Like imagine being locked in on a rate and you're like, man, I'm at a 4%. I'm so glad I'm locked in. Or I'm at a 4.5%. I'm so glad I locked in. And then you get a day or two before closing and the bank says, we're not going to honor that commitment. And they relock you 1-2% higher because of the type of product it is. And we're seeing that happen to, not like when I say we, like it's not my company. We're not seeing that at my company, but we're seeing and we're reading in articles, we're reading in, mortgage, chats and groups that are like national groups that of like things that are happening to clients and buyers for loan originators are seeing, and things that are happening with certain investors. And that's kind of scary to be right there. Or, hey, I need one more day, and they're saying, no, we're not gonna, we're gonna lock you at worst case scenario. And it's like, well, I'd pay thousands of dollars to keep it then, because if you go worst case, I don't qualify anymore. Yep. That's what's happening on some of these non-QM loans. Okay. So it's definitely interesting to see. So it's very important when we get these rates locked that, you're on it. And this is the part that a lot of people don't know. A lot of it, there's the lender, like the underwriter, the processing, everything else. But you know who like is like equally crucial in that process? The borrower, title, appraiser. Like these are all things like, so if you're a borrower and you're like, man, I'm going to get all my documents a week before closing, I got plenty of time. You might be shooting yourself in the foot, because what if there's something like, until we see it, we don't know if there's going to be if it satisfies or if it creates a new condition. Mm-hmm. So you want to get those things in as quickly as possible. Title, like, not responding. Insurance companies not responding. I was telling you before we hopped on, I've got an agency that all I needed was them to update a mortgagee. It's a refinance for a client. And all I needed them to do is to update a mortgagee. And I'm going on over a week for this request, in which our team is calling and emailing them multiple times a day. And they're just hitting me with the default, oh, it's being processed. Mm-hmm. And I'm like, I don't know about you, but I know that the 5 seconds that it takes to change one mortgagee and update it to a new mortgagee, it could be done in 30 seconds. It's just they don't. And the irony of it is, they're a company that's 5 minutes from our office. Like, if they wanted to try to get business, that's not the way to do it.
No, it's not. No, and I understand your frustration. I mean, the one I had last week, I think I was telling you, is they originally told us they needed the condo questionnaire in order to 2 days before closing. Takes 7 to 10 days, but if you pay a rush, it's 3 to 5. Had to call and beg on that one, and then all of a sudden they wanted to do a VOE again before closing, which I understand most companies do, but it's a Department of Defense contractor. Yeah. Try and get a hold of them. I literally spent all day Thursday, because we're supposed to close on Friday, trying to make phone calls. The wife finally was able to get a hold of somebody for us in the HR department. And the person who had sent it over from the lender never even checked to make sure they got it. They didn't get it. They had no clue. So we had to resend it directly to them. Luckily we got it closed. But it's frustrating some days. I mean, those are ones that you lose a whole day because you're tracking down, because you've got this commitment to get things closed, and that's where communication is extremely valuable, and working together as a team. So, but I think that's interesting with the locks, and to make people super aware of that is know the day you're locked. And it really just kind of hit me, because that I use a program that puts dates out. Yeah, I think one thing I'm going to start asking the loan officers, when's the lock date, and putting that in there. Yeah, so that I know as well, so that I can keep track of it, and it will remind people, hey, the loan lock expires. Yeah, it may be 3 days after contract, but you said that one thing, that mortgagee clause that you need to get it closed, and you're not getting it. Now all of a sudden, guess what? You're not closing on Friday. You're gonna have to wait till Tuesday, because you still got to get it on Monday. Get it to the underwriter. Underwriter has to say, okay, now we can get the package out and get it closed on Tuesday.
Yeah, exactly. And
our lock expires on Wednesday.
and that lock has to be like, what if you close on Wednesday but you fund on Thursday? If your lock expires Wednesday, it's not good.
It's not good.
It'll be through funding. Yeah. There's a lot of little things that you don't realize. Like in our system, we built out our system, like we put every lock, when it gets locked, the system, and day 5, 4, 3, 2, 1, 0, before the lock is set to expire, our LO and anybody on that file gets a notification. Hey, lock is set to expire on this day. Lock is set to expire on this day. lock is set to expire. And then when it comes over day zero, like everybody, even our, and I'm one of the owners, like I get the notifications on day zero because I'm making sure that that doesn't expire. Like we shouldn't get there. But that's kind of, so it's crucial. Like we've seen rates, we see volatility. Like sometimes you get lucky and you have what's happening this week. We've got a rebound. Hopefully, I think if we see another day of positive, which it looks like it's starting out that way. Hopefully it's a start positive in positive, not a positive to negative day. Yeah. I think if we see that, that's going to be reassuring because I feel like that'll be kind of like, hey, we tested and then we bounced off of it, and then we're settling back into where the market wants to be right now. So I'm really hoping
it would be nice to see the market settle a little bit for next going into the spring. So we have some consistency for our clients, knowing that hey, we may go up an eighth, go down an eighth, but we're pretty stable on where we're going to be. We know what we're working with. So that's awesome. Thank you for explaining the locks. I know a lot of people have questions on those. So that was great. I think that's it for today. I think we've hit a lot of points. I think we need, like we stay on top of the volatility, and our job here is really to let you know, hey, what's going on in the market on a weekly basis. Because just like this past week, man, it was up, it was down, it was sideways. And any direction it could go, it seemed like it went.
Exactly.
And thank you for starting the beard again. If you've noticed, since he started his beard again, rates have gone down. So you're not allowed to shave
again. Now. There's a correlation.
Yes. You are not allowed to shave again.
Absolutely. And then just one closing remark on my side. I know that there's a lot of talks of recession and everything. If you look at the amount of recessions that we have, typically, home values don't decrease in recessions. They may stagnate, but they don't decrease. Obviously, the Great Recession of the early 2000s, where the housing, that housing collapse occurred, that was the one time that we really saw in the last, 20, 30 years where we saw home prices really go down. So I think even if we see something where we settle down, we do end up in that recession type. I think there's a good probability that they stay flat, or maybe they dip just briefly, but then come right back. And I think overall, I don't see the housing market going crazy.
No, and I think Orlando's unique in itself in the growth that we're having, which we kind of may isolate us a little bit, where our dip will not be as bad as most other sections of the country. I truly believe that.
Yeah.
Well, wonderful. Thank you so much. We'll see you again next Thursday. Everyone take care and have a great day. Bye-bye.
Okay, guys.